And today we are super fortunate to have Scott Mather with us. Scott is the CIO of U.S. Core Strategies and a managing director at PIMCO. He is a member of the investment committee and a generalist portfolio manager. He oversees the firm's global ESG portfolio integration and sustainable investment activities. And previously, he was head of global portfolio management. Prior to this, Scott has held a number of roles at PIMCO for a number of years after spending some time at Goldman Sachs, New York. Scott has 26 years of investment experience, has a master's degree in engineering and an undergraduate degree from the University of Pennsylvania. And we are in for a real treat today, Scott. Thank you so much for joining me.
My pleasure. Nice to be with you, Russ.
Scott, I am so excited to speak with you today. First and foremost, just for our listeners who aren't familiar with you or your background, can you share a bit about your life and your story?
Yeah, sure. I guess an unusual background. I grew up in Oregon in a small lumber town. And so it was kind of a pretty isolated place, beautiful place. But definitely it was a kind of a one industry town. Seems like it was one of these things like every recession or downturn caused huge unemployment and all kinds of things. But I don't know, for some reason I became interested in worldly affairs, I would say, and financial markets at an early age. I was a paper boy and I delivered a few Wall Street journals and occasionally would steal some peeks in there. And so it was always fascinating to me and kind of led me to say, well, I need to get out of here. And I decided to head east for a big culture shock and ended up at the University of Pennsylvania in Philadelphia. So there you go.
And the rest is history. Decades on Wall Street. And now, can you tell us a little bit more about your role at PIMCO and some of your focus on ESG investments?
Yeah, so as you mentioned, I sort of manage the portfolio managers that manage portfolios that are focused on ESG or sustainability. And then I also manage the portfolio managers sort of in the traditional business for our large U.S. Mutual funds, as well as sort of a hands-on manager of some of the biggest funds that we have. So, that's my current role. As you mentioned, I've had others. I've headed up our global portfolio management from Newport Beach, but also headed up European portfolio management. So I was in Europe for 6 years. Then prior to that, I was back here co-heading the mortgage and asset-backed securities desk. So every 5 or 6 years has brought me some sort of big change here.
Yeah, it sounds like it's been an ever-evolving career for the last 2.5 decades. For our listeners who aren't familiar with PIMCO, can you share a little bit about PIMCO? For some who haven't heard of PIMCO, I'll tell them now, PIMCO is a mammoth firm. And the younger generation, a lot of them haven't heard of PIMCO yet, although they will, of course, very soon, either listening to this podcast or once they begin their career and understand just how significant of a player the firm is. Can you share a little bit more about the firm?
Yeah, sure. It's so we currently manage about $2.2 trillion or dollar equivalents. That's for clients around the globe. And all kinds of clients. We manage retail mutual funds. We manage a lot of separate account money for pension funds, specifically insurance companies, basically every kind of and corporations and what they have on balance sheet. So really varied client mix. And in terms of what we do, it's mostly fixed income. It's mostly bonds, but we also have a pretty large alternatives business. It's about $30 billion and it gets overshadowed by the other things we're doing. And we have an equity business and a multi-asset business that together add up to about 50 billion. So a lot of different pieces in motion. That we have a sort of a history that has always made us, I guess, one of the biggest in the bond market, even though we might not be a household name. We're certainly one of the biggest traders and managers of fixed income in the globe. So certainly if you're go to an investment bank and and ask them who their biggest counterparties are in the world of trading, will show up. And almost everything we do is in the active space. So we're not big in the ETF space. We're not a passive manager. We are very performance oriented. So always seeking to beat benchmarks and deliver better risk adjusted returns. So it's kind of in that sense, we're sort of unique from some other large asset managers, in that everything we do is active.
Talking a bit more in detail about the investments the firm is making, I wanted to ask about your focus on ESG. You have a background in engineering. You've worked in global markets throughout the course of your career. I'm curious if that experience informed your work in ESG, or really what drove you to focus a lot of your investment activity on ESG.
Yeah, I think that's a bit of it. I, still always, have an eye for, science and what's going on in the world, maybe away from direct application to financial markets. And so, yeah, I mean, for a long time, I've been concerned about the pace of change, and the challenges that we face with respect to the E aspect in the environment, and they're all around us. And certainly I have detected for a long time that creating many more problems for us all as the world population grows and we continue to consume resources and all those types of things. And I think too, it made me more comfortable, I guess, with some of the subject matter in terms of digging into it a bit, in terms of thinking about how it may have an impact, and is having a big impact now, of course, on companies and financial markets and society at large. So I looked around at PIMCO. We've sort of we've been early in that space. We launched what were the first socially responsible mutual funds back in the late 1980s. So back then that was the way people were looking at sustainability. It was largely just based on excluding problematic sectors from the opportunity set of what you're managing. But we were early in that. One of the early signatories to the Principles for Responsible Investment, which is now this huge organization, basically 100 trillion of assets represented in that. But when we joined in 2011, it was pretty early days, and early for an asset manager. So we sort of have this history of being involved in these sorts of issues. And we've also, we're kind of the firm that is always thinking about innovation and very focused on what the next 5 to 10 years will bring. So that's, we have lots of processes built and lots of discussions and lots of research ongoing to think about, what's going to be important, not just, this year. And that usually takes too much of people's mind share. It's usually, and even for professional investors that know better and know they should be acting differently, it's just human nature. They get consumed by what happened last month and what's going to happen next month. But that's why we institute all these processes to push our thinking out, and it spills over into business planning, et cetera. So when I took a look around in about 2015, I saw that we were doing these, interesting work in different areas related to ESG and sustainability. But there was a huge opportunity that I saw, which is really to better unify our efforts and to get bigger buy-in. Because what I saw this as, I describe it now as a mega trend that's going to impact society and financial markets in ever greater ways every year. And so, we organized ourselves, spent some time studying what's the best way to think about organizing our activities. I think we came out with a winning strategy. We came out with what we call our ESG platform, with the idea that what we want to do is be able to provide the best in-class advice to investors of all sorts, and that speak different languages of sustainability. And you'll find different people that have a different focus. Some people might be really wanting to focus on the social aspects. Some might be wanting to focus on environmental. Some are more tilted towards governance as being the dominant thing. But and it varies in different regions of the world. So the concept was to say, let's get everybody at the firm involved in this effort, which is different than how many people have approached it. Let's get every group to develop some expertise And that's how we can really be powerful. That's always served us well at PIMCO, is to really get the whole firm moving in the same direction together. And so, as they say, no good deed goes unpunished. And they say, well, Scott, why don't you lead that from the investment side? Okay, so that's how that ended up happening, as it's happened many times with changes in my career here. So it's been, it's an exciting thing because you've got so many people involved here, and I think, well, if I'm being honest, I pretty much know we're leading in the industry on certainly from the fixed income side in developing the marketplace and putting ourselves in the best position to give that advice to our clients. So that's sort of that's the goal for us, is to keep pushing forward. And I can talk about later, if you want, some of the market innovations that we sort of inspired, and kind of how we go about thinking of engaging. And this is a big part of our platform, how we engage with corporate clients, how we engage with policymakers, regulators, and how we engage with investment banks to sort of develop the marketplace.
I would absolutely love to ask you a handful of questions on both subjects. First, I want to dive into ESG a little bit more, and because you're an expert in this field and are a leader, as you have mentioned, rightfully so, in the industry and in a lot of the developments in this market, going back decades now, several decades. I wanted to get your thoughts on ESG in a little more detail. At PIMCO, you, quote, exclude, evaluate, and engage companies in order to develop an ESG-minded offering, where engagement entails working with companies to encourage them to make changes to their planning in order to improve their standing. So this actually goes to your engagement question. Can you tell us a bit more about how this engagement typically fares, what this engagement looks like?
Yeah, happy to do that. So we have the opportunity, to engage. We have thousands of meetings with issuers per year. I mean, one of the things that people forget about the fixed income market, what's a little bit different than the equity market, is, issuers of bonds have to come back and resell their story, right? And they have to be concerned about their ratings, and they have to really care about what their large investors think, because we can decide to sell our bonds and not buy the next series if we want, right? So they have a natural interest in this dialogue. So we have this dialogue with them, and I would say we have a deep dialogue on ESG matters with over 600 issuers, and I think it'll be coming out in a couple of weeks, our new annual ESG report, which sort of describes these engagement activities. But basically what we do is engage with issuers on what we think the most material factors are for risks or opportunities for their business, and the things that investors care about, and things that rating agencies are going to care about, because they care about all those things. And so it's different by industry, and it's different by geography. So we we have our own internal ESG scores and a template for what's important, what's material. Of course, we can change that over time. So we're not attempting to engage them on 50 subjects, right? We want to engage on the things we think are most important for that particular industry or organization, right? And so we use our analysts. We have a very large analyst group. They're experts in all those industries, and every issuer basically has its own analyst. And so what we do is we work with them to develop a template for what we think that issuer should consider or do that would improve their ESG-ness. What will they do to keep moving forward? And sometimes it means sharing, okay, this is what your competitors are doing, and this is what we like to see. And they're pretty receptive. I mean, we say it's cooperative. I mean, we're not there to name and shame. We don't really ever do that. What we are there to do is to provide advice to them and say, look, these are things that are important. You should really try to address these issues, because it's either going to be a risk or a big opportunity for you. So there's a pretty receptive dialogue that we have. And then we track those engagements internally. We have a system so that basically everybody can see everybody we've engaged on, and we track it over time. So for us, a big part of the engagement process is tracking the momentum that we have. How quickly is a particular company or issuer moving forward, and are they delivering on the commitments they've made in the past? And that's to this idea of momentum. And so that's an important part of our framework. And what we'll do, of course, this is fairly recent with respect to ESG because we really ramped up this platform in 2015. So we don't have 20 years of history, but it's still pretty relevant when you just look back the last 3 to 5 years. So that's an important part, is to track, be as quantitative as you can, but certainly track progress. And look, if we find somebody's not delivering or really lagging, it's certainly going to change certainly change your rating within. And I would describe it just another foray off here into the wilderness. But what you find in academic studies, and there are lots of them, is that there's a big correlation between management quality and their focus on sustainability and ESG. It's almost like a mark of distinction. And you'll find that, like, even if you ignore what they're doing directly with respect to ESG and sustainability, there's a very good correlation between those who have well-developed sustainability frameworks and plans with other signs of management quality. And that's why you tend to see those companies doing better. So, that's just another way to think about it, and why it's so important for us to integrate it into everything we do, not just like a narrow set of ESG products. Yes, it's important for those, but it's really important in thinking about it, how we evaluate everything we're investing in.
When you think about how you are evaluating what you're investing in, when you're looking at the broad spectrum of criteria that you're assessing, think about key markets, key industries, where there are best in class investments or potentially worst in class investments. I'm wondering, when you look out at the landscape, what would you consider best in class investment sectors that are also exceptional on ESG criteria and screening? Kind of what meets both the return and the ESG criteria best in your experience?
Right. Well, typically, if you look at, let's say certain sectors, it's technology. Okay, they have big benefits, but they've also made big strides, right? Shifting to renewable energy. All the big tech players, they tend to be very focused internally on sort of this idea of stakeholder, capitalism, if you will. So they've cared a lot about not just what investors think, but what their employees think, what their customers think. So on lots of these metrics, that is, if you just look in absolute terms, that's an example of an industry that scores really high. But what the way we typically approach is say, okay, that's great. You might want to have a technology tilt, but what we're really trying to do with our ESG scoring system is to look within a peer universe. So basically, we could say, okay, if you want to invest in an oil and gas, sector or benchmark, well, we can tell you our views on who is best and who's moving the fastest, right, and responding to the challenges that they're going to face. So, we're not trying to, once again, the idea is, there's especially the big investors that we do business with, they deploy very well diversified, sophisticated portfolio strategies. And so they might be invested in sectors that don't meet those absolute metrics, but they still want to make sure that they're investing in the best in that sector. So I think that's really kind of how we're approaching it. That's the value we add. Now, I just cited two probably extreme examples of absolute ESG-ness, right? You've got, technology up there, and then you've got, of course, the fossil fuel business, which has, in many cases, it's not just because of the carbon footprint, but also because they'll have a history of controversy with respect to employment, their labor standards, and a host of other environmental problems and things to deal with. So there you go. There's two extreme industries, but the concept we have is to not tell people that, oh, you shouldn't invest in those things, because there's a good reason why many people need to. And here's another idea too. Look, some of the big major fossil fuel companies have already put on the agenda, on the calendar, saying we will not be a fossil fuel company. We'll be an energy company. And so that transition is underway. And within the next 10 or 20 years, they're making the big shift. And so, you want to, as an investor, there's good reasons to think, well, you might want to be part of funding that transition. You want them to survive. We need energy, and, you want to invest in the ones that are making the transformation happen.
As you talk about technology being, an example of a best in class in investment, class, and also excellent on ESG markers, high ESG-ness, as you said, and actually begs a question about crypto. I don't know if you hear at all about Elon Musk's commentary on crypto, on Tesla accepting it for payment and then not accepting it for payment because of the energy impact. Would be incredibly curious because everyone's talking about crypto right now. What your perspective is on cryptocurrency, both as an investor broadly, but also as someone who is focused on ESG, just given its environmental, social, and governance implications on the world and on companies.
Yeah, that's right. I mean, look, it makes no sense if you look at it, in terms of the energy drain, energy impact, right? It's very poor. And I mean, you look at the comparisons. I forget exactly how many countries it represents, just Bitcoin alone, in terms of their energy consumption. But that's the scale of the mining, and of course, it gets more and more energy intensive over time. So there's some problems there now. Okay, that's an example. I didn't realize that they, Tesla, the example you said, that they moved away from accepting Bitcoin for those reasons. But I remember seeing the headlines and thinking, this is not going to go well. So there's an example of, maybe thinking it through a little bit further would have helped. Now, we have groups here working on a lot of, cryptocurrency, but look, it's early days, and I think it's too early to say where it's going. There's a lot of skeptics here on our side as well. But I have to think this problem with the energy consumption is going to be a problem at some point. I don't know what happens. I don't know if it's required. Maybe you could think about a tax on holdings. You could think about a transaction tax. But I don't think it's going to be able to, escape the eyes of many regulators, largely because of that.
I think you're right, definitely. When you look at some of the figures, it is absolutely astronomical. Looking at the energy usage of it, so I think there hopefully will be some really meaningful pressure on technological innovation, on the mining process itself. I think you're going to see that forced just because of the amount of assets going into the space. I mean, the market cap of decentralized finance has increased tenfold. Just recently, you see a massive explosion in Bitcoin, Ethereum, and all the major coins in the market. And I would hope, at a minimum, to see that there is massive transformation in the technology behind it to reduce the energy consumption. That said, there's trade-offs. I want to kind of move into a conversation about trade-offs broadly as it relates to ESG. Just like with cryptocurrency, there are trade-offs between liquidity in the market and accessibility in the market, regulation and energy. In ESG, oftentimes clients will see a trade-off between returns and their portfolios being ESG responsible. So I'm curious to what extent your clients, or you historically had clients, think there is a trade-off between returns and having their portfolios meet ESG benchmarks.
Yeah, that's like I think the percentage of clients and investors that think that it's necessary that you give up returns to invest in a more ESG or sustainable fashion is declining, but it's still out there. There's a group, I say people were really skeptical maybe 5 years ago, but there's more evidence, of course, that you can outperform by focusing on sustainability issues. So like anything in investment, I say there's a way to do it wrong, and there's a way to do it better and right. And you're always going to have a mix of people out there in the marketplace, right? Some are going to get it wrong and some are going to get it right. And the other thing to consider too is I say to us a little bit like if somebody just came and said, I want to invest in credit, let's say, that doesn't tell us much, right? Do they want to invest in a very focused area, some subsector of the market with the highest potential returns, or do they want diversification? Do they want to be global? They want to be focused on the U.S. Do you want to be invested in investment grade or high yield or loans, or it goes on and on. So it doesn't tell you much. Just like when someone comes and says, well, I want to invest in in ESG or sustainability, there's a spectrum of opportunity. And what we've observed is if you keep the opportunity set large and you kind of approach it that way, then we think that's the best chance of delivering very good risk-adjusted returns that are consistent with prior history. Now the world's changing so fast. I question whether some of the the history doesn't tell you so much when you have the pace of change on E and S accelerating so quickly. I'm not sure that history tells you if you invest in a non-ESG fashion, you're going to get the returns you used to get. Sometimes, Ross, I approach it this way. I tell people, well, if you can make so much money by investing in the worst ESG companies, then where are all those ETFs? Where are all those strategies? I don't see them. So that tells me something, because if you can make a lot of money doing that, someone would be doing it. It's the opposite, right? So, you can kind of just look at the marketplace. I mean, I'm willing to say that, if it gets very extreme, there could be some group of poor ESG performers that get so cheap, that you could make money by investing in them. But what you see is the opposite. Typically, you can improve risk-adjusted returns by incorporating this information into your analysis, and it is a sign of management quality. Companies that have those well-developed plans are thinking more further forward, and they're thinking about stress testing. Nobody knows exactly, the pace of change. All they seem to observe and agree with is it's accelerated. So if you don't have a strategy and you don't have the ability to stress test and do the what ifs and think forward 3 to 5 years, you're much more vulnerable. So, I'm getting to this point of you don't have to give up returns necessarily. You need to think about it very carefully, and you need to keep the opportunity set broad. I would say on the other end of the spectrum, let's say you only want to invest. Let's say you're an equity investor or you're a bond investor, and you only want to invest in renewable energy. Well, okay, that's an extreme example, but you're going to have a higher volatility portfolio perhaps than if you are a diversified investor. You'll be very E-centric and score well on those metrics. But of course, you might not have the best risk-adjusted returns. You're not diversified, right? You're in one industry, susceptible to how that develops, right? And more concentrated, probably in a handful of companies. So that's how I think we approach it and answer that question. It's like saying, if you're a credit investor, are you going to deliver X returns, or what is your risk-adjusted return? Well, I mean, don't know what you mean by being a credit investor. And once again, there'll be people who, even if you did know what it meant, you said, well, it's global investment grade credit. There's going to be people who do it well, and there's going to be people who don't do it well. So, you can't really form an opinion on that basis.
It's really interesting to think about how portfolios have performed over time, especially when you're looking at these ESG indices and comparing and benchmarking these portfolios against them. ESG indices have done quite well recently, and some argue that this is due to factor exposure. Many indices have a lot of exposure to tech, which has done really well since the great financial crisis, and relatively little exposure to energy and value stocks, which have done rather poorly. Do you see ESG doing well, even in the case that certain sectoral winds change?
Well, I think,
or do you think the wind is blowing in this direction, and ESG is just getting behind where the winds are blowing for good?
Well, yeah, and when it comes down to this issue of how concentrated your ESG portfolio is versus the alternative, and I still think there'll be cycles where it's pretty obvious, the one that we've just gone through, where it's pretty obvious what's driving some of the performance, because you can it's far too obvious, that it's coming through the COVID crisis and what that's done, and what technology has done relative to rather to travel and leisure, et cetera, right? I usually describe it, they're going to be different cycles. And I think as an investor, if you're going to invest in let's say, ESG sensitive way, you can expect maybe a different sort of return profile, but I would still expect, if you're doing it in a sensible way, you're doing it correctly, the application is everything. Then even though you might be in a slightly different cycle, you should have every reason to believe that incorporating those factors in that analysis is going to put you ahead of the game in terms of risk-adjusted returns over a cycle. So over, let's call it a 3 to 5 year cycle. So, you shouldn't expect zero tracking error with what's going on with the traditional portfolio, but over time, those things wash out. So that's what we usually talk about with clients.
That makes complete sense, and I appreciate you sharing. I'm just thinking through what those conversations must look like. And I'm curious how favorable and how open clients have been to those conversations recently, and if you've seen those conversations going more smoothly in the last year versus 2, 3 years ago, even amidst COVID and a lot of the changes that we've been seeing.
Yeah, we have a lot. The number one thing is we have a lot more of those conversations. They've grown about 30% year on year for each of the past couple of years, even through this past COVID year. So that's what I mean by this mega trend. I mean, there's a lot more conversations. There's a lot more movement in that direction. The amount of, let's say ESG and sensitive assets that we manage is about 650 billion, and that keeps growing. So gives you some idea of what's taking place. Now you may, and that's how we sort of, form the dividing line, but you just have this huge year-on-year increase. And that means, as usual, there's a spectrum of people in terms of their knowledge and what they want to accomplish. And, many are just starting. And if they're just starting, I mean, we spend a lot of time with them talking about the first steps to take. And then there's the ones that are really advanced, right? And they know exactly what they want to accomplish. They're looking for the metrics that we could provide on every aspect. And they want to see that improvement and track it over time with respect to ESG. So, there's a spectrum, but I think the most important thing to think is about how quickly the interest is growing. And I mean, some people ask the question, well, if it grows at this rate, won't it be the whole market? Well, yeah, that's the point. It should be the whole market at some point. That's the idea, right? I mean, that will happen at some point where it's so mainstream that maybe we don't separate it anymore. It's just one of the things you do. Like it's part of the analysis. Like you wouldn't think of, ignoring the income statement or, not looking at, the balance sheet, but maybe you should, maybe at some point you could see like sustainability and ESG factors will be perhaps, and I think this is direction, incorporated into the traditional financial reporting. So, if that's the case, yeah, it'll be mainstream at some point, and that would be a good thing.
As you describe that future, I hope it is the future that we see. I hope that in my lifetime, I get to see that world. And thanks to the work that you're doing at PIMCO and that you're doing with a lot of your partners, I'm confident that we may be able to see that world too. For whatever my opinion or my forecast is worth. One thing that's interesting is Warren Buffett recently successfully opposed 2 shareholder resolutions calling for Berkshire Hathaway to compile annual reports on how companies are meeting ESG targets. He mentioned doing this might be onerous as the companies are small and that it can be, quote, very tough to decide which ones benefit society. I'm curious what you think of those criticisms. You think they're mostly germane to Berkshire Hathaway, or are there problems for investors across the landscape?
Well, I mean, look, there's problems in terms of reporting and getting started with that for many companies, and the smaller companies that, smaller that you are, the more onerous it may seem, right? Because you don't have these, teams of people that you can deploy to do this. I mean, I saw that criticism, but I can see the future, and the future is going to be mandatory reporting. Now, what the cutoff is in terms of size and what that reporting looks like, not quite sure. But I can tell you this obviously happened in Europe already, and the thresholds there are relatively small in terms of the breakpoints. And so they're capturing a lot of mid-sized companies. And so whether, and I think that's happening in the rest of the world. And of course, the SEC has an open comment period right now in the U.S. on what should be happening in the sector. And so lots of industry organizations and And people like our firm are giving them ideas about what that could look like to try to make it not too onerous, right? Remember, the first steps, are important steps. And maybe the right idea is to have these breakpoints where smaller companies don't have to do as much. But the issue that he's going to face is that Berkshire is not a small company. So there you go. And that's just going to be the fact. And it doesn't matter. I mean, he's a large conglomerate. I mean, I don't think large conglomerates are going to get a break in this just because, they could say, well, look, we have these, I mean, any company can make this. They could say, well, that division is small. That division is small. I shouldn't have to report on those. I mean, come on, that's not going to work. So I don't think it's going to be a successful line of argumentation, but it's fine, I guess, to buy a year or two.
It's inevitable. Warren, just get
It's
on board.
inevitable.
You might as well do it now and save yourself the Reuters headlines.
Yeah.
It's interesting, going back to your point about ESG criteria being as standard as three statement financial analysis. That sort of being a long-term outcome, it just becomes something you do. You don't even think about it as something special or unique or differentiating necessarily. That actually begs this kind of broader system level question, kind of moving from this conversation about trade-offs into the longer term and system level implications of ESG investing. Do you think, in your mind or among the minds of investors, there is some kind of specific goal or concrete endpoint in terms of the various measures which have been constructed for ESG? Or is it more about constant improvement until we reach that day where we realize we've been doing this thing for 100 years and we used to have a name for it and it used to be a thing and now it's just what we do? Is there some sort of day where ESG investors say, great, like we've achieved our goal, or is it just constantly iterating?
I think it's going to be constantly iterating. I think, it'd be ridiculous to think that we're going to see enough improvement where, we sit back and say, oh, job done. And I think people just realize, the realization is that the path of, sort of the economic models and the path that we've been on for the past, let's call it, 30, 40 years is not sustainable. A lot of things are going to have to change, right? You can't, it's huge disparities around the world, huge problems that need to be solved. And of course, we've got the big environmental and climate problems, which maybe are the most important to get underway at the moment. So, to think that we're going to be successful and it doesn't mean people shouldn't try, but to be successful, it's going to be a difficult journey. Let's put it that way. To really be able to say, oh, mission accomplished. There are targets out there. Of course, you see the net zero commitments, where we're trying to get, the Paris alignment, okay, trying to be on that trajectory to keep temperatures below 1.5 C. Okay, that's not going to happen. We should be talking about 2 C right now. And, if there's not a lot of action, we'll be talking about 3 C, and that's a big problem, right? So but there's a timeline and, there's a path. So that's an example of, a scientifically based path that puts us on to net zero by 2050. And then you see lots of companies and countries committing to say, well, we're going to develop plans to get there by 2035, right? Do more than their fair share. So that's an example of clear targeted framework. The other one I'd mention is, and it doesn't get enough airplay in the U.S. maybe, but it does if you look at the financial markets and what's taking place in reporting, is the Sustainable Development Goals, which came out in 2015, sort of a globally agreed framework, 17 goals addressing all sorts of sustainability issues. And if you look under those, then there's 169 key performance measures. So, and those get analyzed, every year. So there's a framework that people can look at and say, okay, what does it mean when we're talking about, healthcare? What does it mean when we're talking about, justice? And what does it mean when we're talking about, to underlying, look at the underlying KPIs. But even if those get achieved by 2030, which is the goal, the 2030 agenda, it doesn't mean that everything would be solved. And of course, when you look at what's, there's a lot of effort by countries to move in that direction, but, way off target so far, going, 5-6 years into it. So anyway, it's just to say that there are frameworks out there. They're constantly evolving, but it's good to have a target, and you need a date to get people, focused on that, and get, to build up a coalition of people to move.
I love it. It's constant iteration. We have goals that we can look to, that we can have in our mind's eye, that are scientifically based, as you said, empirically based, that world governments, major corporations, major investors like PIMCO have all agreed on, are goals that we should all work towards. And there are some actors, corporations, governments who are even trying to buck the trend, who are trying to get to those goals in half the time as some others, pulling more than their fair share. It's interesting when you hear about the ecosystem, the sort of the system level commitments to ESG, to improving our portfolios in this way. I'm wondering, from your perspective, over time or even recently, if the trend toward ESG is pushed by investor demand, or is it the result of governmental or institutional leadership? Like, you've talked about some of the market innovations that you've inspired at PIMCO earlier that I'd love to talk about in a moment. But yeah, is it investor demand driving this? Is it institutional leadership? Is it both? Would love to hear where you think the mega trend is really coming from.
Yeah, I see it coming from many directions. I mean, it really, I would say, this latest surge is more investor, driven. Excuse me. And but before that, it was largely governments and the voting population. I mean, if you look at Europe, okay, the Green Party, for instance, is very well represented in many countries, and so there was a political movement. And the political movement was then pushing, pushing that down into business, and then investors responded, right? So that's an example where that push, was more politically led. But if you look at, I mean, the wherever you see these political movements, you see investors caring a lot more, and that's part of that movement. And I would say, even part of what we've seen in the U.S., right, with what's going on with this administration's agenda, and especially on climate, but a variety of other things, right? I mean, they didn't, it wasn't just like, 20 years ago that they were all individually focused on those issues, right? It's politically driven, and there's a market response that's happening, at the same time. So I think, it goes hand in hand, these sort of movements, and there's a kind of a moment, it seems like different countries, different issues. There's a spark. There's sort of a certain critical mass of interest or focus on it, and then it takes off. And from many different sectors, whether it's regulatory or political, or it's all market driven, right?
It begs a question about institutional leadership, and I have a few more questions I'd love to ask if we have enough time for me to get to a few more. With the institutional leadership that PIMCO is providing as an example, would love to understand what you think institutional leadership will look like and needs to look like. And this would be a great time for you to share some of those market innovations that you mentioned PIMCO has inspired in the process of being an institutional leader towards ESG.
Yeah, happy to do that. I usually, when talking to, senior management of large companies, I usually describe it this way. Look, every large company has a host of sustainability businesses probably that they're in, that are really focused on those particular topics, and they have other parts of their business that have challenges and risks if they don't come up with a good plan. So the point is, almost any large company has these, and we could identify 5 or 10 that are the most material to their financial well-being and performance over time. And so when they start thinking about like that, then they say, okay, well, yeah, you're right. And we want to address those risks, and we certainly want to take advantage of those opportunities and grow those businesses that are focused on these sustainability factors and businesses. So then they start thinking about, okay, this is a way to add value to the organization. And one thing that we encourage them to do is if you adopt this idea of focus on the stakeholders, I mean, increasingly your consumers care about it and they want to know what you're doing, and they respond well to it when you develop products that are aligned with that mission. Your employees care about it. It's difficult to attract and retain talent unless you're focused on this, and your investors care about it. So, one of the, speaking about the innovations, things that we've brought into being that allows more companies to clearly define that mission and to align their balance sheet and their capital markets activities are these, what are called sustainability linked bonds. And sometimes I call them SDG bonds, but basically just saying, like, you can find businesses that are making advancements, and they may not be able to issue a green bond, because they're not building, something that's directly a green or renewable energy, but they can set some targets, they can focus on those pieces of businesses, and they can link the capital markets activity with that. And by doing that, investors have a way to directly invest with that company and that mission, and they have a way to describe really what they're doing to not just investors, but also to other stakeholders. So, that part of the bond market is growing very, very quickly, more like 100% year on year. And we think that ultimately will be, green bonds will be a subset of this. So think about a, $10 trillion marketplace or so within a few years. So, that's it. And we think it's one of these things that always, it causes companies, whenever you develop a plan like this, they also start raising the bar faster within the company, right? Everybody gets more focused on what they're doing and gets excited about it, and there's just more movement. So that's one of the reasons why we think it's an exciting sort of innovation for investors, because they can align with that mission, they can understand it better, but also what it does within a company. I mean, as soon as we've observed this time and time again, as soon as a company issues a green bond or a sustainability linked bond, all of a sudden the C-suite starts to care about it more. It trickles through the rest of the organization. That's really an important, kind of factor in changing company behavior.
That reminds me, and this is one of the two final questions I want to ask you. The second to last is about the CFO Task Force. You talk about changing company behavior. You and I, over the course of the last year, have spoken a lot about this UN Global Compact, CFO principles on integrated SDG investments and finance. And you have helped co-launch this CFO Task Force. As I understand it, it includes the 17 Sustainable Development Goals, some of which are quite ambitious: zero hunger, complete gender equality. I would love it if you can share with our audience a bit about your CFO Task Force and what CFOs are doing to advance this cause and the role that you and PIMCO are playing in that.
Sure. Yeah. So the UN Global Compact, if people haven't heard about it, it's the largest global group of associated companies. It's about 13,000 of all sorts of different sizes, and that keeps growing pretty substantially. And it's led by it's sort of the private sector of the UN, which many people don't know that exists, but they should. There's lots of country networks and lots of interesting things taking place there. So in participating with them in some other events, it was the idea. I mean, we kind of noticed from our engagement that we do with corporations that there was a gap. The companies had sustainability officers, and then they had the CEO, but then the treasurer and the chief financial officer were often very not engaged on what's going on in sustainability or these market developments. So we thought this would be really powerful if we could build a platform, an association where, one, they could learn from one another in a pragmatic way, and then also understand how to make value within the organization, whether it's their capital markets activities, and issuing things like sustainability linked bonds and green bonds, or whether it's coming up with a value proposition for sustainability within the organization. I mean, this is a group, CFOs, are basically doing close to 15 trillion in annual investment globally, right? So they have the purse strings, and they make investment decisions. So that's maybe the most important group you want to talk to. But so we thought, let's build this organization and start with trying to get every country and every large business or industry represented. we're up to, something like 60 or so far, with the goal of going to 300 by the end of this year. But the idea is to really make a template. So one, they can learn from one another how to create value based around sustainability within their organization, how they can report and share that with their stakeholders, and how they can, navigate the capital markets better with that. So, and then importantly, the lasting effect will be that small and medium-sized companies can find something in every one of those 300 companies some business that looks like them, and a country that they're from or based in. And so that they can, even if they don't have this huge amount of resources, they say, aha, I could do that, right? I could address this. I could build a business around that, or I could describe this better to my stakeholders. So that's the goal in the end. We developed this platform where they all get to advance and build that value by following these principles. But more importantly, the global benefit will be, creating this easy, learning platform for the medium and small size businesses.
It's absolutely inspiring, Scott. Every time you provide an update on the CFO Task Force in any forum for Scholars of Finance, and I get to hear it, there's more CFOs that have signed up. It's gotten larger. The momentum is absolutely thrilling. Thanks for sharing for all of our listeners. With that said, I know we're coming up on time here, so I'm just going to ask you one final question. It's a bit of a softball about Scholars of Finance. You and I now, we've been going back and forth for over a year, talking about Scholars of Finance. You've helped inform our vision for Scholars of Finance, our vision of a world where all finance leaders are stewarding capital to serve the greater good. You've been helping us achieve our mission, inspiring character and integrity in the finance leaders of tomorrow. And you've been incredibly generous with your time. You've been a keynote at one of our symposia. You've spoken to our students on a number of occasions. You've been advising me as a CEO, young startup founder, CEO personally a little bit. I want to just ask why you've been so generous. What's inspired you to get involved with Scholars of Finance? And for all of our listeners, why might you encourage them to get involved as well?
Yeah, happy to do that. Well, I think, it's a great organization because the mission of only way to make the world really a better place for everybody, and I describe it this way: to make the economic pie better and more inclusive, bigger and more inclusive, is to focus on these types of issues, showing that finance and financial markets must be a force for good in moving to a more sustainable and better future. And I think there are episodes in time in different parts of the industry that haven't always approached it that way. So many people, if you're outside the world of finance and outside the world of Scholars of Finance, you'll run into those people who just think, oh, it's a bunch of greedy people out there and doing poor things in the world and hurting people somehow. But of course that isn't the case. And so it has to be that health. We say sometimes here, healthy markets and healthy societies go hand in hand. So there's always mistakes and things that happen that are bad and wrong. But the more people that are engaged in the way and with the vision and the values that you have at Scholars of Finance, then the better off the financial markets will be, the better off society will be. Anyway, I think that's an exciting path and journey, and that's why I'm engaged.
Scott, amazing. Thank you so much. And all of us at Scholars of Finance, we're so grateful that you do engage, that you continue to share your insights and wisdom with us and experience with us. With that, I want to thank you for joining us on the podcast today. Any parting words for our listeners that you want to share before we wrap up?
I've shared so many words already. No, I don't know. Keep up the good work. Keep up the good work, and you guys keep pressing ahead with new ideas and new ways to touch more people and do more things. That's it.
Amazing. Scott Mather, great having you today. Thanks for all the insights. Hope you have an amazing rest of your week and look forward to having you on again soon.
Sounds good. Thanks, Ross.